Alphabet is down 10% on the day when you count the results for the day and the trading after hours. And that's crazy because they just reported results. And I'll be very honest, I think they look pretty good. That's what we're going to dive into in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel where the goal here is to help 1,000 people achieve financial freedom much sooner. And you guys already know, or at least the Patreons already know, that I'm a huge fan of Alphabet. This is a stock that I've been watching for a while now, and I'm really just hoping that the share price comes down to the point where I can buy it, and I'm going to explain all of that right in this video. So starting you guys off, you guys can see that Alphabet is down 10%. So they were down 3% on the day, and now they're also down another almost 7% after hours, which is absolutely nuts for a company like Alphabet, especially on these results. And you'll see as I go through them that I think this reaction is a bit excessive and they might make up some ground when the stock opens tomorrow. But you can see here that in addition to being down almost 10% today, you can see year to date, they're down almost 20%. And on a trailing basis, they're trading at a P/E ratio of 21 times earnings, which is kind of crazy for a company like Alphabet that's still growing on all cylinders. And you'll see that in the next couple of slides here. And of course, you can see here the major reason why Alphabet is being pushed down, I think, is largely because the market sentiment is turning against. You can see that the S&P 500 is now down almost 13%. So I think there's more pessimism being baked into the market as people are getting more and more weary due to the high inflation and the Federal Reserve policy to tame it with higher rates. Obviously, advertising is a cyclical business, and for a company like Google, you could see lower ad spend as a result of a declining market, but we're not seeing it just yet. In fact, we're seeing the opposite, which I'll show you. Now, of course, I'm covering more and more companies this year as more and more opportunities have come up, but you guys may remember last year, I didn't really cover a lot of names. In fact, I almost felt silly for the number of names that I actually did cover because almost everything was overpriced. So what was I really doing with my time? Well, I was doing what any value investor should be doing when the market is as hot as it was in 2021. I was learning how to make cake pops, and I fell in love with making briskets. I even bought a smoker. But the one additional thing that I was doing, which the Patreons know very much about, is that I was building detailed models on some of my favorite companies with the understanding that what goes up must come down, and eventually inflation would get too hot and the Fed would have to move, and some of these companies would correct. And in my opinion, some of them were overcorrect. Now you can see here just today, you can see that Roku is down almost 10%. And you go down that list, you can see Alphabet is down 3% just on the day. But of course, they might open lower. But Alphabet, highlighted in green, is one of the companies that I really want to add to my portfolio. You can see Zillow's up there in green. I've already added Zillow to my portfolio. Microsoft, H&R Block, Starbucks, Viva, those are all companies that I'd like to add eventually to my portfolio once the valuations get better. And of course, this list is accompanied by a full detailed model on every one of these companies. So if you wanted access to that list, you can get access to it at the $5 a month Patreon tier, but I'm not going to plug that right now. So moving into it, you can see that Alphabet's results did come relatively in line at $68 billion. And of course, the market was expecting 67.9 billion, so pretty much in line. They did miss on the diluted EPS level. So the market was expecting 25.7 or 25.8, and they came in at 24.6. So under by 4.5%. Not a big deal in my opinion. So I don't understand the overreaction here, or the decline at least. Who knows if it's an overreaction? I think it's an overreaction, but it is what it is. Let's see what the segments look like. And to be honest, I think that there's a lot of room for optimism when you see how the segments performed. So moving on, you can see that Google search was up 24%. You can see that YouTube ads was up 14%. And Google Cloud, which was a huge surprise, was up 44%. Now, beside those, you can see I have under, over, and other words. But essentially what I'm saying is YouTube ads, although it's up 14%, which is not bad, I was expecting 30% on the year to keep Google increasing in line with what I think the expectations are. So YouTube actually underperformed, and I will take full responsibility for YouTube underperforming. I thought that this channel being here would allow advertisers to pump more ad dollars in, but they just haven't found my channel yet. So here's to you, advertisers. Find this channel, advertise on it. You got the best audience. Okay, moving on. You can see that Google Cloud absolutely outperformed. They're up 44%. My expectation is only 25%. And the one big surprise is if you think that ad spend is cyclical and it would decline in a rising interest rate environment, then you would think that Google search and other would actually decline. In fact, Google search and other increased by 24% versus my expectation of 15%. And so where am I getting these expectations from? Well, they're right built into the model with respect to how I forecast revenue. You can see that Google search right at the top, 15%. And then I expect the growth to actually decline to around 12.5% through till 2026. You can see YouTube ads, 30%. It's relatively in line with how it's performed, but that might be a bit aggressive for 2022 and 2023. We'll see how the rest of the year plays out. I'm not changing my forecast on it just yet. And then, of course, subsequent to 2024, I bring that expectation down, and then in 2026, I bring it down again to 20%. Google Cloud. Now, my expectation of 25% is actually higher than what management was telling us. They're actually forecasting 21%. So the fact that Google Cloud did 44% and it's in line to increase at the same rate that it increased in 2021 and 2020 is phenomenal. It blows my model out of the water. So I'm not ready to take up my expectation just yet. My valuation is still really high at around $4,000 a share. So it's just fine where it's at. But if Google Cloud continues to outperform in the subsequent quarter, I will bring up my expectations on this one. And of course, you can see overall, my revenue expectation growth for 2022 is 17.2%. And you can see that they're currently on the quarter over by 27.6%. So way higher than my overall revenue expectation. So here's where I'm saying that Google or Alphabet is doing just fine, at least in my opinion. Moving into the valuation, you can see that using a terminal multiple of 22.5% and a terminal discount rate of 11.5, on the EPS basis, this company is a $4,000 per share security, so it's effectively trading at 60% of its valuation. Now, if you use a free cash flow per share valuation, same terminal multiple, same terminal discount rate, you see that I'm getting to the same effective valuation of $4,000 approximately. So same sort of valuation. And the reason why this works is because Google's such a mature company that eventually these two things, EPS and free cash flow per share, do converge and effectively becomes the same thing. And so that's what you're seeing here. And so once again, you can get access to my model and the valuation and the other stuff that I'm going to show you in this video at the $5 a month Patreon tier. And once again, if you don't like it within the first month, message me in Patreon, say, hey, Tay, it's not for me, and I'll fully refund your money. No questions asked. Okay, let's move on. The other thing that I want to point out is so many people focus, especially value investors, we focus on the intrinsic value and what the share price is as a percentage of the intrinsic value. And you can see here that it's 60.5%. But the other thing that I want you to focus on is that there's other indicators which tell you what the quality of the company is. So Alphabet has zero debt, which is phenomenal in a rising interest rate environment. They're absolutely inflation resistant, their platform is. In fact, they could probably increase prices at a rate that's higher than the level of inflation. Their economic moat is stronger than anything I've ever seen in my life, to be honest, better than Coca-Cola even, and that's a huge Warren Buffett name. And their intrinsic value is expected to be realized through growth. So that's the only knock that I would put against Google, is that I'm not getting a growth plus revaluation for how they realize their intrinsic value. They really have to grow into it. So that's the only knock I'd put against them. However, I still think, you see green across the board here. I think Alphabet is top shelf. And if you were to look at all of the companies that I have on the list, I have approximately 50 companies and growing. There's only 7 names in that list that I believe are top shelf, and Alphabet is top of the top. So the fact that this thing is coming down and we could potentially buy it for $2,000 or less is very exciting for me. However, I always like to look at the cash secured puts just to see if I can get into something right now, because you never know if their share price will actually come down to where you want to buy it. And most of the time, for companies that I get excited over, the share price never actually comes down to where I want to buy it. And so I end up still earning an acceptable rate of return, usually around 20% or so, selling cash secured puts and generating that yield. So just looking at the cash secured put here, so you can see that code is the 230120. That code just means January 20, 2023. And you can see for the $2,000 cash secured puts, you can generate a premium of $125. And so when you put that into the cash secured put analysis tool, which you get as part of that $5 a month Patreon tier, you can see that that $125 equates to around an 8.5% put yield. So if you're willing to buy Alphabet at $2,000 per share and are willing to put the money aside and generate a return on it, you can generate an 8.5% annualized return for the time that you wait. Personally, it's too low of a return. I like to target at least 15%, but I like it to be around that 20%. I don't know if I'll get there with Google. However, I believe that there is downward bias on this share price, and so it might continue to come down. And so the other interesting thing that Alphabet announced is that they're going to be continuing to repurchase shares up to $70 billion. Now, this has historically been a knock against Alphabet. They just have way too much excess capital on their balance sheet. You can see here that they have approximately $140 billion of what I believe is excess capital sitting on their balance sheet. So they can absolutely fill that whole $70 billion of shares that they want to repurchase tomorrow. So that's interesting, but also expect them to continue to increase that share repurchase authorization. I think it's a good time to purchase your shares when they're getting close to around 50% of their intrinsic value. I think it's very accretive for investors. I would hope that they use sort of like an at-the-money structure and set the at-the-money purchase structure at around $2,000 per share. But I think any price that they buy it at right now, where the current market valuation is good for them. And of course, guys, if you currently own shares in Alphabet and you bought it at slightly higher and you're sad that the share price is coming down, taking temporary losses on securities is just the name of the game. The company will eventually revalue. I truly believe that. But, there are some losses that you can take that will never come back. For example, the fact that I lost my hair and now I look like Mr. Clean. So if you're feeling bad, just remember you at least probably still have your hair. So don't feel too bad. Now, guys, more importantly, this is just a quick overview of the quarterly results for Alphabet. If you want to see a deep dive into the company, you can get to that video series right here.